Welcome back to Switzer and Australia's Business Channel. If you can believe the market analysts who tell us that the overall index is heading up over the year, the crucial question for us is what stocks will actually be doing the driving? Investment expert Raymond Chan from Morgans may have some insights the 24/7 Market Watcher comes up with. Let's just see. And Raymond joins us from our Sydney CBD studio. Raymond, thanks for joining us.
How are you, Peter?
Very
good
good
to see you.
Same here, mate. Look, a couple of my experts this week have talked about whether we're in a secular bull market or a cyclical bull market inside a secular bear market. Do you have an opinion on this one, Raymond?
Well, I'm of the view that we are in a secular bull market. That's driven by two main factors. We have a lower Aussie dollars. We have a lower interest rate. So those are the two key things I really like about this market. How often do we, see an earning yield higher than the interest rate?
Very seldom, mate. Very seldom.
Absolutely. So, we have one chance of it, back in 2008. And surprisingly, since 2011, we have a constant earning yield. As of today, it's around 4.45%, higher than the 10-year bond yield, which is 2.35%.
Yeah.
But better still, the cash rate at the moment is 2.25%. According to what Mark suggested a moment ago, we could be heading to 2% in May.
Yeah, exactly right. So from your point of view, even if this is a cyclical bull market, it's still got a few years to run as long as you have that relationship between interest rates and yields.
Well, as with all the bull market, there's always going to be a bull market correction. But as long as we see we have a high earnings, then the stock market should worth more. And people keep asking me, where's the earnings coming from? It's quite simple. We look at the Australian economy. We have a growth recession. We have a weak growth, but the growth rate is still 2 to 3% in Australia. Well, this year is more likely to be 2 rather than 3, but with the economy growing, with the population growth, then we should see higher earnings.
Yeah, and the important point is this, Raymond. We generalise 2 or 3%, but there are some sectors that are growing very fast and some sectors growing very slow, and that gives you an average number of, say, 2 or 2.5%. It doesn't mean some sectors aren't doing well.
Absolutely. You look at the resources sector, over the past 20 years, they account for around 10% of our GDP. Yeah. That, of course, they're going through a tough period at the moment. But what's come up now is the construction sector, which in the past 20 years is account for 9% of our GDP growth. So, we have a strong construction growth at the moment, so that sort of offset the weakness in the resources sector. What's
your view on the dollar? When you're trying to do your calculations, what kind of level are you putting on the Aussie dollar?
Well, with the Aussie dollars, since it's free floating from 1983, there's 3 dominant factors affecting it. So the first one is the Australia and US interest rate differential. Yeah. The second is commodity. The third one, surprisingly, is the US budget deficit. So whenever we have a budget surplus in US, we will see strengthening in US dollars and the Aussie dollars going down. That happened last time back in year 2000.
Correct.
When our Aussie dollars dropped below 50 cents. Okay, so what happened now is, we, in terms of the interest rate differential, is narrowing. So, the US is talking about rate high, but in Australia, we're talking about rate cut. The commodity is still going down a little bit, but the US budget deficit is an interesting point. The last year, we saw a big improvement of US budget deficit from 10% of GDP to only just below 3% of GDP.
It's a big improvement.
Exactly. That's why we see the big US rally, until a few weeks ago. But the 2 out of the 3 factor now is actually going against the US dollars. Okay. So let me explain. What happened now is, the Aussie dollars has gone down significantly from $1.10 to where we are today, around 78 cents against the US dollars. I think in a very short term, I think we may see a little bit of bounce in the Aussie dollars. Until, toward the end of the year, I think it will resume again the Aussie dollar's weakness. Yeah. So that creates, I guess, a window of 2 to 3 months opportunity on the high Aussie dollars for us to capture the opportunity to invest.
Okay, so what kind of stocks will you be chasing possibly in that window?
I think, first of all, it's the overseas earners, and with some overseas funds manager that, invest in international shares. Those will be the investment where I would take advantage on the back of the Aussie dollars bounce back, hopefully over the next 2 to 3 weeks.
Okay, name some names, Raymond. You're not going to get off easily here, mate.
Well, about a month ago, in your show, we talked about Macquarie Bank.
Yes.
Since it's gone up about 8.5%, I'm still very positive about Macquarie Bank on the basis of two catalysts. One is 65% of its earnings is from offshore. Second of all, is more and more people are warming to the idea that Macquarie Bank is a assets manager, is a funds manager, rather than just a pure investment bank. That's my first idea.
Yeah.
The second idea is only just become available about 2 weeks ago. It's the Magellan Global Equities.
Yeah.
Okay, when we talk about Magellan Global Funds, which is a very successful international funds manager, in the old days we can only buy it through, say, the wholesale funds, the retail funds, or the listed investment vehicle. But now it becomes available. We can invest in the ETF. So the listing code is MGE that only just become available, very transparent with daily liquidity. So on further strengthening, hopefully on the Aussie dollars.
Yeah.
Make use of our buying power to go overseas.
So Raymond, people will be quite surprised about this because it really is like a hybrid between a LIC, a listed investment company, and an ETF, isn't it?
Absolutely, and of course, with investors, with the benefit of investing into a LIC or listed investment company is they get access to the franking credit. That probably wouldn't be the case for the ETF, but what you get from the ETF is the transparency, because the bid and the offer on the market is not dictated by the demand and the supply of the investors. So, as with the ETF trading on the market, if we look at the US market, a big chunk of the money is basically invested in ETF. In Australia, I think this will be a bigger and bigger market for the international investment.
Okay, is there a local company that you like purely because either you think the sector's heading in the right direction or the management's getting it right? Is there something like a company that you like for its intrinsic value and its potential?
Well, it actually a company that just come up with a bit of earning disappointment in February. The company is Seek.com or Seek Limited.
Yeah.
Okay, a moment ago, Peter and Mark talk about the job ad is at a record have a record high at the current level.
Yeah.
What we see with Seek is still 50% of the revenue are made in Australia. However, they are constantly growing their overseas exposure. Well, Brazilian business a bit of the pain. Having said that, I see positive sign of the China as well as the Singapore market. So this is a global company listed in Australia. That get me excited. And the share price certainly has tumbled a little bit, after the disappointing result. But the reason for the disappointment is they want to invest more for growth. That's why the earnings fall short of the forecast. So Seek, I think, is definitely the one I'm looking at, especially if it break above $18. Always buy stocks on the way up, not on the way down.
So you're saying, let's see the trend turn around and then buy it when that trend is heading in the right direction.
Absolutely, and we look at the PE at the moment is around is around 24 times, but with the earning growth, I'm pretty comfortable. In 1-2 years time, it will well fall below 20 times.
Well, a question I get a lot, and I'm sure you get it as well, is there a retailer you like? Given the fact that the dollar is making life better for our retailers, is there one that you think is getting it right? I'm sure you're not going to say Kathmandu, though I did notice that Credit Suisse actually upgraded Kathmandu today.
Well, with the retailer, I try to stay away from the sector. Yes, I do know funds manager who invest in Billabong, reap a fantastic return out of it. but I'm just a type of guy who, really look into fundamental matter into the retail sector. So, if I really have to pick one, there will be a smaller one called Lovisa that only listed on the market last year. But this is one of the few companies where they can control the cost because they have their own factory out of China, and they're selling small ticket item that appeal a certain age group. So Lovisa will probably be the one I can see growth, but not in the general sector.
Okay, one last question. A lot of brokers and analysts are really positive on BHP and Rio. I think Rio got about a 25% rise. What's your feeling on those two companies?
I'm actually quite positive on BHP. Well, despite what happened in China and the iron ore price and and the coal price, you name it. I'm positive on the basis of the demerger of the South 32. The reason I say that is because the demerger are the long core assets. Once it demerged from BHP, they actually quickly increased the return on BHP quite significantly. That allowed BHP potentially, surprisingly, to do capital management. So I'm actually quite positive on BHP. Well, not so on Rio Tinto at the moment. I still, see the trend on iron ore is pretty difficult. And over 90% of the revenue is come from the iron ore division. Yeah,
mate. Thanks for joining us on the program, Raymond.
Thank you.
That's Raymond Chan from Morgans. Coming up next, the CEO of Freelancer joins us. Are the winds of change heading in the right direction for this online company?